Right now on the COMEX exchange, there are 7.5 paper claims for every single ounce of physical silver actually sitting in the vault. We'll break down the exact mechanics driving this historic run on silver and show you how to position yourself before the vaults run completely dry. For decades, the global financial system has operated on a very comfortable assumption that every paper silver contract traded on Wall Street was perfectly backed by a tangible chunk of metal. This chart shows the reality of that backing today. Since 2020, COMEX registered silver inventories, the metal actually available for delivery, have collapsed by 70%. People point back to 1980, and the Hunt brothers used massive leverage to corner the paper contracts and drive prices up artificially. But the 2026 crisis is fueled by a different force: massive industrial consumption that persists regardless of market sentiment. The evidence is sitting right in the global exchanges. Or rather, it isn't. We're seeing a massive, sustained drawdown of above-ground warehouse inventories globally. Strategic reserves are evaporating as metal leaves the vaults and enters the supply chain, leaving global exchanges physically depleted. To understand where it's all going, we have to look at the green technology sector. Silver is the most electrically conductive metal on Earth. That makes it an absolute requirement for the global solar boom, with modern photovoltaic panels requiring massive amounts of silver paste to function. Add to that the rapid expansion of electric vehicles and the massive build-out of AI data centers. Each of these technologies acts as a multiplier, exponentially increasing the rate at which we use industrial silver. This graphic tracks global silver supply versus demand. This unrelenting consumption has pushed the market into a structural deficit for the 6th consecutive year. To cover that shortfall, the market has drained over 800 million ounces from above-ground reserves since 2021. Tech manufacturers are permanently removing this metal from the global supply, locking it into hardware and infrastructure that will remain in service for decades. So if demand is through the roof and prices are hitting record highs, why doesn't the global mining industry just dig more silver out of the ground? It comes down to a concept called inelastic supply. Look at this breakdown. 80% of all silver produced is a byproduct of mining copper, zinc, and lead. Only 20% comes from standalone silver mines. This creates an economic paradox. Silver prices can skyrocket, but if the market price for copper isn't high enough to justify running the mine, that operation stays closed. The silver output remains completely flat. These base metal operations are massive, complex logistical undertakings. They simply cannot pivot or scale up production just to chase a spike in silver prices. Before we look at what happens when this system breaks, let me know in the comments, which metal are you betting on for the rest of 2026, gold or silver? The global silver supply is effectively trapped. It is physically incapable of expanding quickly enough to meet the needs of the green tech revolution. When you have raging physical demand slamming into a wall of stagnant supply, extreme pressure begins to build beneath the surface of the paper markets. The historic 2026 breakout past $55 an ounce was the moment that pressure snapped. It was physical reality violently divorcing from paper market suppression. Because the supply cannot increase, the market has to rely on demand destruction. The price has to skyrocket until it becomes so expensive that industries are forced to stop buying. You can see this panic playing out right now in Asian physical markets, where buyers are paying extreme premiums over Western paper exchange prices just to secure actual metal. This explosive price action is the financial system desperately trying to ration a critical, shrinking resource. The US government and global industries have recently reclassified silver as a critical mineral, signaling a shift in how the world views its strategic importance. This forces a tough question for anyone holding a portfolio today. How much of your wealth is sitting in real, tangible assets, and how much is tied up in digital paper promises? Holding paper derivatives during a physical supply crisis leaves you incredibly vulnerable. There is an absolute security that comes from holding physical precious metals that a screen simply cannot replicate. In an era defined by multi-trillion-dollar national debts and digital balance sheets, the ultimate economic leverage belongs to those who possess the physical metal. Wall Street's long-held paper illusions are finally shattering against the hard, undeniable reality of physical depletion.